Thank you for attending today. We will begin our formal presentation in few seconds as we wait for few more guests to join. Hello everyone, and thank you for joining us for today's webinar on retrospective amendment to ESR in UAE. With less than 4 months for the first due date to submit the detailed ESR report, the UAE has made significant amendments to the law relating to economic substance regulation. The new amendments under the law have introduced changes in governance mechanism, scope and applicability, compliance procedure, and also enhanced the quantum of administrative penalties for non-compliance. In today's webinar, we will discuss and delve deep into these amendments on businesses and the way forward. Joining the discussion today, we have Lokesh Gupta. He's a senior manager, transfer pricing. Lokesh has been with the practice for almost a decade and advising clients across industries. Before we begin, kindly note that all participants are in listen-only mode. If you have any questions, please share them with us through the question box on the right-hand side of your screen. We will address your queries at the end of the webinar. Without further delay, we shall start the webinar. Over to you, Lokesh.
Hey, thanks, Jitin. Hello all, and I extend a warm welcome to you all to this webinar on the exciting topic of economic substance regulations. I'm Lokesh Gupta. So very broadly, the agenda of today's webinar is to cover the critical amendments that were introduced by the ministry very recently. And these are very significant in a sense that the previous law, which had come into existence about a year and a half, around April of 19, that law has been completely repealed and the new law has replaced it. So in today's webinar, we will discuss and see what all changes have been introduced and how they are impacting the businesses in the UAE. So coming to the background, I thought that we should, since everything is being refreshed with this, amendment or the new law, I thought it will be good to first understand what is the origin of economic substance regulations in the UAE. So it's basically, as some of you might be aware of, the BEPS project, a very landmark project of the OECD, wherein a significant work is still ongoing to ensure that there is tax-related transparency amongst the jurisdictions. So the BEPS project dealt with as many as 15 action plans, and it was introduced, or most of the reports were finalized and released in the year 2015. 2018, somewhere mid of 2018 is where we saw UAE also joining the inclusive framework of the OECD, and thereby now they are also a member of the inclusive framework of this BEPS action plan. And as a member, the UAE is supposed to implement certain minimum standards that were laid down in this BEPS project. There were 4 minimum standards in very brief: Action 5, 6, 13, and 14. 13 deals more on the country by country reporting, or you can say a transfer pricing related disclosures. But in today's webinar, what we're planning to discuss is Action 5. Action 5 is basically the purpose of Action Plan 5 was to curb the harmful tax practices that are adopted by certain jurisdictions by giving a very favorable treatment when it comes to tax or income tax. And as most of us know that UAE does not have a direct income tax regime as of stage. So therefore, Action 5, the recommendations of Action 5 became very critical for UAE to adopt. So what does Action Plan 5 says? So the mission statement, if we were to go through, it says revamp the work on harmful tax practices with a priority on improving transparency. So like I mentioned, this entire BEPS project was, centered around enhancing the tax related transparency between the jurisdictions, because it was realized that, lot many jurisdictions are being used as tax haven by the multinational corporations to avoid taxes or to evade taxes. And therefore, it was realized that you need to improve the tax related transparency. And of course, it is not just that the uh, machineries have to be put in place to improve the transparency, but with this entire framework of BEPS or report 1 or action plan 1 to action plan 15, what was intended is that there is a seamless exchange of information between the jurisdictions, so that, you know the information relating to this tax evasion is captured and acted upon in time. That was the whole purpose of bringing in or introducing BPS project. So with this objective, of implementing the minimum standard of the OECD BPS project, the UAE introduced economic substance regulation. And as I mentioned, the first set of regulation, or the resolution was passed early in April 2019. Thereafter, various guidelines came, including September 19, where the regulatory authorities, etc., were defined. Then January 20, when FAQs, etc., were released. These were very helpful FAQs. Then the relevant activity guide. This was an important document because the original resolution had very little guidance, or so to say, the clarification or explanation on the definitions. And this relevant activity guide gave a lot of examples, practical examples of how to read those definitions or how to interpret those definitions. Similarly, then May 20, notification form, etc., were prescribed. And in most cases, the notification filing deadline was set as June 30. So June 30 was when, most of the free zones had prescribed a deadline, and all the businesses in UAE, I am presuming most of them have already filed the notification. And then came this amended regulation sometime in the previous month, August of 20. And out there, it was not only that, the structural changes were made in the way in which the ESR report or ESR compliances are going to be processed, but this amendment also ensured, or also kind of mandates, that all the taxpayers or all the licensees are now required to file a re-notification. So for example, if let's say a client located in DIFC had furnished a notification to the DIFC before the due date of June 30th, uh, they will have to again re-notify or file a fresh notification with the Ministry of Finance. Unfortunately, the prescribed form or the fresh due date to file this re-notification has not yet been out, and we are expecting that, with the end due date of 30th December, 31st December, this due date for filing the notification could come anytime. What is expected is basically, the forms, etc., and the manner of filing. And of course, the December 2020 is a deadline to file the first economic substance report or the annual return, which is a more detailed uh, information that the licenses are supposed to provide. And that report is due in December 2020. Even the form and format of that report has not yet been prescribed. However, what is there is the content. So the content that are going to go into the detailed ESR report are already mentioned in the ESR regulations. In fact, even in the amended regulations. So broadly, you would know what contents are required. However, the form and manner of filing is yet to be prescribed. All right. So at a very glance, if you look at what amendments have been introduced, then like I mentioned, one of the most significant part is that the previous law, which was issued, and later many guidances and FAQs were introduced, all of them has now been repealed, and there is a new law in place. A new law plus a new guidance has also been issued to support or to explain the law. So therefore, repealing the original law is one of the significant change. Second, while all the set of relevant activities which were originally covered in the erstwhile law have been continued, and there is no fresh introduction of any other relevant activity. However, the procedure, or you will say how the ESR information is going to be processed at the governance level, that has been changed significantly, and we will see in the subsequent slide as to what is the change in the process. And another interesting aspect when I read this amended law is that there are no transition related provisions, meaning that the new law completely nullifies whatever has been done with regard to the previous or erstwhile law, and therefore the need of filing a re-notification or a new notification. But most of these changes, as I analyze, and we will see that in the subsequent slide in today's webinar, is most of these changes are basically to align the recommendations of BEPS Action Plan 5. So these are now more or less in line with the international framework. All right. So what does this amendment mean? So what are the implications? So, in four buckets, if I were to put it, there is the impact is that now the businesses will have to reassess, because now there are some changes in the scope and applicability. The exemption list has been enhanced, or to some extent exemptions have been removed for the previously exempt licensees. Similarly, the definition of certain relevant activities like distribution and service center business, etc., have been amended. So to that extent also the applicability needs to be reassessed. So the first bucket is, every licensee will now have to broadly reassess given the changes that have been introduced, and check whether the applicability that was determined sometime back basis the previous law, whether the position holds good or whether they need to change their position. Similarly, once you do that re-examination or reassessment, the licensees will have to do a re-notification basis what is the amended position. And like I said, certain definitions have been changed, including that of intangible property. So to that extent, the licensees will have to revalidate their positions, and basis the revised position, then the organizations will have to decide their strategy, because this time not only that these procedural or the law related to the governance mechanism has been changed, but the new law has also significantly enhanced the penalty. So we will see that in the subsequent slide as to what is the quantum of penalty in the new law. All right, so what is the need, or why are we saying that there is a need to reassess? So if you look at the previous definition of the coverage of this law, then previously the old definition of the licensee was that every natural person or a juridical person, in a sense, company, etc., and it applied to onshore as well as offshore companies, partnerships, branches, and everything. So previously the coverage was very wide, I would say, and it included individuals, etc. However, if you look at the, just a second, I just need to minimize. Yeah, if you look at the new regulation, then while partnership firms and the corporates continue to be getting covered under the regulation, however, the natural persons or the sole proprietorships, those who are operating within UAE, have been now exempted, and they are not required to do ESR compliance. This is, big relief to the small or the medium size proprietors or the individuals who are doing small businesses. Now they don't have to, kind of worry about the economic substance regulations. And we will see as to how the exemption list has also been, significantly changed. So in a nutshell, if I were to see how does it apply to the branches, then there are three possible category of branch operation. One is there could be a UAE branch of the UAE entity itself, or you could have a foreign branch of something, or a establishment within UAE. So coming to the first category, a UAE branch of UAE entity, in the previous law, the economic or the regulation were very clear that the compliance needs to be done on the basis of per license. So if the branch has a separate license, then branch as well as the headquarter, although both of them are within UAE, were required to do two compliances separately. But now, no, to their relief, the new regulation now provides that if you are a branch of the entity which is established within UAE, then you don't need to do two compliances. As long as the headquarter does the compliance, the branch is exempted. Coming to a situation where you have a foreign branch, let's say an entity is incorporated in UAE and it has a foreign branch, let's say in Bahrain or somewhere else outside of UAE, then out there it has been clarified that as long as branch is paying taxes, etc., or is a tax resident of a jurisdiction outside of the UAE, then it is not covered under the ESR regulations, and which is for the right reason. And lastly, you could have a scenario where you have a branch office here in UAE, but a headquarter, let's say, sitting somewhere in Europe. So in those situations also, it has been clarified that if you have a branch whose income is being subject to tax outside of the UAE, then the branch did not do a ESR compliance or they are exempt from a ESR compliance requirement. So in a way, you would say that with respect to the branches, a lot of relief has been provided. So coming to the exemption list, another few categories that have been exempted from the compliance requirement or from the economic substance regulation is, if you are an investment fund. So previously there was no clarity whether the investment fund, which does no other economic activity but only holds the investments, whether they are supposed to be doing the ESR compliance. But now it has been clarified that if you are an investment fund, you did not do a economic substance regulation related compliance. Similarly, if you are a tax resident anywhere outside of the UAE, then you are not supposed to be doing a ESR compliance in UAE. And this, in essence, a branch-like setup which is being uh, uh, or which is a tax resident of outside of UAE, then you need not do a compliance here or you are exempt. Similarly, if you are an entity which is wholly owned by UAE residents, so this third category is basically, if you have an establishment which is completely domiciled within UAE, meaning no cross-border dealing, no cross-border presence, and your operations are confined within UAE, then you did not do, because like I said in the beginning, the purpose of introducing this economic substance regulation is to ensure that entities are not doing any tax planning, which in a way jeopardizes the tax or the sovereignty of the other country. And therefore it has been clarified by into the new regulations that if you are an organization which is completely domiciled within UAE, then you are exempt from the economic substance regulations, and this is going in line with the objective. And similarly, for the branch setup, if you're a branch of a foreign entity, like I mentioned, and your relevant income is being subject to tax outside of UAE, then you are completely exempt. Now, interesting aspect of the exemption which was not there in the previous or the erstwhile law is that if you are claiming an exemption under any of these categories that I mentioned, then you're supposed to produce an evidence. Now, while the regulation does not specify what kind of evidence you need to furnish, but for example, if you take a tax resident in jurisdiction other than UAE, I would say the evidence or the document could be that you produce the tax residency certificate. And similarly, if you have to substantiate that you are completely domiciled or your operations are completely domiciled within UAE, then the evidence could be, these are only indicative documents, mind you, these are not specified in the regulations. But for the third category, the evidence could be that you submit the financial statement, etc., which clearly demonstrates that you are completely domiciled within UAE and you don't have any cross-border presence or affiliation. And for the last category, of course, if you have any document from the foreign tax authority, which gives evidence of the residential status. Interestingly, if you don't provide these evidences to claim the exemption, then your exemption may not be allowed, and the authority to verify whether the documents have been appropriately submitted in time or not, that has been given to the respective regulatory authority. So for example, if you're a company located in DIFC, the DFSA or the DIFC authority will have a right to scrutinize and verify whether you are rightfully claiming the exemption or not. Need to revalidate. Yes, this is an important aspect because all those companies who have already done the compliance as per the previous law, they will have to revalidate their positions. So first example could be, if you look at the definition of the connected person in the previous regime and the current regime, then the connected person previously had uh, a slightly broader meaning, in a sense that it is related through direct or indirect ownership or control or common control. This was a simple definition in the previous law. But in the current law, if you refer to the definition of the connected person, it describes that you have to be part of the two or more organization. And most importantly, it puts an emphasis on the consolidated financial statement. So what it means is, for the other party with whom you are dealing with or with whom you are entering into a transaction to qualify as a connected person, you and the other party have to be getting consolidated into the consolidated financial statement of the parent entity. So to give you an example, let's say there is company X which is in USA. It has a wholly owned subsidiary in UAE which is company Y. Then company Y can be said to be a connected person to company X because it is getting consolidated on a line by line basis with the US company. At the same time, if you have a company Z, let's say in somewhere in Europe, and the company Z is only 20% held by the US company, then although it is qualifying as an affiliate because 20 or 25% is held by the US company, but because that European company is not getting consolidated on a line by line basis with the US company, the UAE company and the European company are not or will not be qualifying as a connected person. So this is a significant change, and this definition of consolidated financial statement has been basically borrowed from the OECD or the CBCR related law, where it had significant emphasis has been put on uh, the consolidated financial statement or consolidation. So if you're not getting consolidated within the same parent, then you are not an affiliate. Simple as that. So this is in a way, restricting or giving a leeway to those parties who are not getting consolidated, and they can be out of the definition of connected person. The definition of connected person is very relevant for relevant activities such as service center business. Coming to the distribution business, now we know how UAE has been one of the very prime jurisdiction for most of the corporates to set up their distribution entity because of of course the infrastructure part and the other uh, proximities, because of which the groups used to set up a distribution business. So in a way, it's a very popular business model within the UAE for businesses to adopt. Now the change has been drastic, or the definition previously which was there was kind of narrowed down to only set of distribution business. But if you look at the new business, it expands the coverage to many entities. So for example, previously there was a condition that till the time you are importing and storing the goods within UAE, you will not be a distribution business. So previously it was a condition, a mandatory condition for you to qualify as distribution business. And similarly, in the previous definition, uh, it provided or it clarified that when you are doing a distribution business, you have to be importing, storing, as well as reselling such goods outside of the UAE. Now, this reselling part uh, of outside of the EU, UAE has also been done away with. So, meaning if you are any entity which is doing a distribution business, you may or may not be importing or storing within UAE, you will still qualify as a licensee covered for the purpose of ESR compliance. We will see a couple of examples in the subsequent slide as to what are those situations when you would not be importing and storing, but you would still qualify as a distribution business. Now, this particular amendment is completely, to align with the BEPS Action 5 requirements, and therefore, in a sense, this is in line with the Action Plan 5 of the OECD. service center business, again, like I mentioned, service center business has lot of connection with the connected person's definition, and which has been changed significantly. So now you have to see that uh, who is your connected person and whether that person is qualifying the definition or not. And once that is done, only then you will have to start looking at or reviewing the service center business criteria. And there is slightly change in the requirement of the law, saying that previously the definition of the service center business suggested that your provision of services to foreign connected person has to be connected with a business of outside of UAE. So for example, if there is uh, a let's say a call center business of a particular telecom company, which is, if it is providing its services to a company or parent entity located in Europe, then as long as the call center's business is completely, or revenue is completely coming out of UAE territory, then it was, the argument could have been taken in the previous law saying that it is exempt because it is in the connection with business outside of the UAE. But that requirement has been done away with. So now it is very simple. If you have any transactions with a person who's falling or qualifying the definition of a connected person, then you are supposed to be qualifying yourself or putting yourself under the category of service center business. Again, this amendment is in line with the action plan 5. This was changed or amended, I would say, to align with the requirement of the action plan 5. Another important structure which we typically observe within UAE multinationals is having holding company. Now, holding company definition previously said that the primary function of the holding company has to be acquisition and holding, and it draw reference to the domestic law which provides definition of holding company, etc. And if you look at the new law, then the holding company definition has removed the reference to the domestic law which governs the definition of holding company. So now it has been clarified that your sole function, if your sole function is that of acquisition of shares and holding of share or equitable interest, then you qualify as a holding company. Previously also there was a condition of no other commercial activity, because if you're performing any other commercial activity, then you are not doing a holding company business. Now such condition has been removed in the new definition. So as long as your sole purpose is to acquire, hold, share or equitable interest, then you qualify the definition of holding company business. Intellectual property business, there is a slight amendment. uh, we have seen how intangibles are used as a mean, kind of to park profits in the tax havens. So therefore, this is a very important issue to be highlighted when you are designing any law to deal with tax related transparency. We have seen, in past multinational groups, preparing a IP holding structure where the IP holding company does nothing but only owns the IP. It derives all the returns from the IP, and then it parks it in the tax haven. So such structures, have been increasingly being questioned, even in jurisdictions which have a direct tax regime. So therefore, it was very important that this issue is dealt with appropriately. And the amendment has been done for a very right reason, I believe. Now it has been clarified that if you own an intangible which you haven't created, and you've since you haven't created, that means you would have acquired it from some connected person, and R&D etc effort was also done by the other person, which means that you're a simply IP holding company which has simply acquired the IP, let's say at a negligible value from the group company, and now you are kind of exploiting that IP to generate royalty or the license fee income. Then you will have to prove uh, to the authorities or in your ESR return that your incomes are basically meeting the substance test. And the substance test requirement for intangible related transactions are slightly uh, different compared to the routine transaction. So therefore, I mentioned that this is a very important issue or a relevant issue if you have any intellectual property recognized in your balance sheet, then it has to be analyzed appropriately from the ESR compliance perspective as to what was the origin, who performed, so to say, a DEMPE function, or what you call it, development, enhancement, etc. And all that analysis has to be carried out to come to a conclusion whether the income generated out of this intellectual property is appropriate or not appropriate. Now, outsourcing arrangements, like I think most of you might be aware that outsourcing arrangements were even previously recognized and uh, discussed at length in the previous law. So same goes under the current law also. So it has been quite clearly mentioned that you could have a company which is not performing a core income generating activity. And if you're not performing a core income generating activities also, that's fine, as long as you are outsourcing those core income generating activities. So what does this exactly mean? So for example, who can you outsource to? You can outsource to third party, or you can outsource to your related companies also. What can be outsourced? Like I mentioned, a core income generating activity, even if you're not doing, but outsourcing, it can be done. The change in the new law is, you can be outsourcing certain activities, which is very prevalent in most of the multinationals, from the cost reason, from the geography reason, is that, most of the multinational companies tend to outsource their IT related or payroll related compliance to outside of jurisdiction. So for example, India houses most of the IT related back offices or delivery centers. So similarly, that has been recognized in the new economic substance regulations, and it has been said that it is permissible, or it is fine if you have an outsourcing arrangement with a company which is outside of UAE for IT or payroll related issues. However, there is one of the requirement for the economic substance regulation is to meet the uh, uh, direction and supervision test. So, as I mentioned, the substance test has to be met in three categories. Uh, First category is that you have to be performing the core income generating activity. Second category is you have to prove that you have adequate employees who are skilled enough to be able to perform those activities which are generating revenue to you. And the third category is that you have to demonstrate that you are being directed and managed within UAE. So as regards the third category, which is direction and management test, it has been clarified that you uh, have to ensure that there is a adequate board meeting, etc., and the people who are attending the board meetings are physically present within UAE. So this was about the outsourcing arrangement. Coming to the requirement to do a re-notification. Now, as I mentioned at the beginning of my presentation, most of the companies have already done a compliance because the due dates, etc., were prescribed as 30th June. And those compliances were done by filing the notification to a regulatory authority. So for example, ADGM employees will do it to ADGM, or DAVSA related companies will do it to a DAVSA authority. DIFC companies will do it to DFSA, etc. So to the local regulator, the compliances have already been done. However, if I read the new regulations, then it has been clarified that even if you have already done the notification, you will have to redo, or you will have to re-notify, and this time not to the regulatory authorities but to the Ministry of Finance. And the portal, etc., is yet to be designed. The form and manner is yet to be announced, and all that announcement will happen possibly soon. But going forward, this being the first year, but the going forward, the deadline has also been prescribed that within 6 months from the end of the accounting year, the notification has to be filed to the Ministry of Finance portal. So for example, if you are a company whose accounting year is from 1st of July to 30th of June, then your first accounting year, let's say, is from 1st of July 2019 to 30th of June 2020, then your due date for filing the notification will be 31st of December, which is 6 months from the end of the financial uh, statement date, which is 30th of June. So 31st December will be your due date for furnishing the notification. And your detailed ESR return will be due 1 year from the end of the accounting year, which is from 30th June 2020 to 1 year, which is 30th June 2021. So that will be your due date to furnish the detailed economic substance report. Having said this, ministry is yet to announce form, etc., for the first accounting year. So the first accounting year for the ESR law is first any accounting year which is starting from 1st of January 2019. I mentioned when I was talking about at glance what are the changes. So one of the important change that has been introduced is about the governance mechanism, meaning that previously, you know, most of the governance related stuffs were either between regulatory authority or the competent authority, which is the Ministry of Finance. But now the new regulations has introduced a federal tax authority into the picture. So now how your ESR information is going to be processed is like this. Originally, when you file the ESR notification or the ESR report, it will go to the respective regulatory authority. And the regulations have clarified as to what will be a role of the regulatory authority. So they will be simply collecting, reviewing, and ensuring the completeness. So in a sense, regulatory authorities are not going to do an assessment whether you are meeting the substance test or not. Their simple job is going to be collecting, reviewing notification, and ensuring that the ESR report, etc., is complete. Similarly, if you have claimed any exemption of any of the category that I mentioned, then the regulatory authorities are supposed to check whether those exemptions have been backed by proper documentation or supporting documentation or not. And they are supposed to be convinced that the exemption has been rightfully claimed. And if they are not claimed, then they can come back to you. What regulatory authorities are also supposed to do is any irregularity or any inappropriateness in the filing of details, etc., they are supposed to report to the National Assessment Authority. The National Assessment Authority is nothing but your FTA or Federal Tax Authority. So any irregularity that regulatory authorities come to know during their initial screening of the ESR information, they are supposed to be reporting. The next stage after all of this processing is done by the regulatory authorities is it will go to the National Assessment Authority, and that authority is FTA, which has been introduced in this new regulation. FTA is supposed to be doing a comprehensive assessment to determine the substance test. So those three buckets which I mentioned about employee, direction, and management, and the core income generating activity, those three tests or those three parameters have to be evaluated and adjudged by the FTA to ensure or to check whether the company is meeting the substance test or not meeting. So they will do an independent assessment, and if they are of the view that the entity is not meeting the substance test, then they have the right to levy penalties, etc., and the penalties have been mentioned in the subsequent slide. uh, Having said this, there is a proper mechanism, like in every law, there is a proper mechanism given to hear or to present your case. If the uh, FTA wants to decide or make any judgment on whether you're meeting or economic substance test or not, you can do your representation and put up your case and explain it as to why you feel, or in a way, an appellate mechanism is already in place. Regulatory authority or FTA, sorry, is also supposed to be issuing the form or manner for ESR report in coordination with the CA. So while the Ministry of Finance will be designing the form, etc., the issuance will happen from FTA, or it will be known through the FTA, and any exchange of information will also happen through this FTA, exchange of uh, information with the cross border. So ministry's role in that sense will be to more, in the governance mechanism, to issue a form and the manner of notification, managing the portal, and of course, if they have to exchange any information, if they because that's the whole purpose of introducing this regulation, that if it is coming to light that a particular company is not meeting the substance test, then as per the recommendation of Action Plan 5, the jurisdiction, which is UAE, has to pass on that information to a trading partner, and that exchange will happen through a Ministry of Finance or the competent authority. So exchange of information, how it happens is, previously, if the licensee fails to satisfy, then if it fails to satisfy the test, then it used to be notified, or the information is supposed to be shared in the previous law. And in the current law also, more or less the mechanism is same, or the criteria for exchange of information is more or less the same. The crux is, if you're not meeting the substance test, the information can be shared with the trading jurisdiction. Right. So this is what I was trying to mention in the beginning, that why there is a need to re-strategize, because the penalties have been uh, changed. So previously the minimum penalty was 10,000 AED. Now the penalty has been doubled to 20,000. Similarly, for filing any inaccurate particulars, again, accuracy plays a very, very important role in these compliance related measures, and everybody want to ensure the accuracy part of it, and therefore, if penalties has been prescribed if you're not filing a accurate particular. Previously, it was 10,000 to 50,000. Now it has been prescribed at flat $50,000, which is at the higher range of the original penalty. Similarly, if you're not uh, submitting the ESR report, or you fail to meet the deadline, then your penalty previously was within a range, but now they have kept it a higher range, which is 50,000. And the maximum penalty in the previous law was 3 lakh AED, which has been now increased to AED 4 lakh. So net, if you observe, uh, you know, it has been made very, very stringent by the regulator to ensure that the ESR compliance is done without any, uh, you know, so it has been made very stringent, and it has been uh, message is very strong that you have to comply on time with an appropriate detail, and that it was there in the previous law also, that if you're not able to meet the substance test and if you don't comply, it could lead to a cancellation of license, and that has continued in the new regulations also. So few case studies I thought we must take to explain what is the change. So for example, I was referring to a distribution model. uh, so in the distribution model, previously, if you are a manufacturer in Spain, for example, and if you have a wholesaler which is in UAE, and you have a retail store within UAE, then reading the previous definition of the previous law, it would imply that this kind of setup is not covered under the regulation. The reason being, the UAE entity is reselling within UAE, and for that reason, it was not getting covered in the distribution business definition of the previous law. But if you look at the current law, this structure will get covered under the ESR regulations, and therefore compliances will be triggered. Another very prominent business model that companies adopt in the distribution business is the build to ship to model, wherein most of the companies do a high sea sales, and in such situations, the goods never really enter the territory of UAE. And if you refer to the definition of the erstwhile law, it put a lot of emphasis on importing and storing within UAE. Now that definition has been amended, and therefore, even if you have a build to ship to model, or if you have a high sea sales arrangement, even those arrangements will get covered in the definition of distribution business. Coming to service center business, uh, you know taking a taking first example where you have a USA parent and you have a subsidiary in UAE, and let's say you have a third party which is located in South Africa. So if you are doing, if the UAE subsidiary is doing invoicing to a USA parent for the services rendered to a South African party, it is, since the USA and the UAE entity are connected persons, the transaction between them will fall in the business or in the definition of service center business. Old and the new provisions are same, and in both provisions it will get covered. However, if you come to example 2, in that you have a USA parent entity, a UAE subsidiary, and a UAE third party. Now, while the subsidiary and parent are connected persons, but the services are consumed by a third party within UAE. So in the old definition, there was some leeway given if the services are consumed within UAE, or at least the interpretation could have been drawn in the previous law. However, in the new law, which has been amended, it has been clarified very clearly that even if the services are consumed within UAE, you will qualify the definition of service center business. So even example 2, this structure, while it was not getting covered in the old law, it gets covered squarely in the new regulation or the amended regulations. All right, what is a way forward? So way forward, like I mentioned, you know, the companies will have to start reassessing the applicability, keeping in mind the intent of the regulation. That is at the foremost, although there are some little changes in the definition, etc. But at the center of it is you have to keep in mind why the economic substance regulations are introduced, and therefore that objective has to be kept in mind while you are assessing the applicability in your case. So just to share, practical example, while the build to ship to model, which I explained in this slide, for example, example 2, while this build to ship to model was not getting covered uh, in the previous law, but in essence, if you look, this kind of structure does meet the objective of the law or the purpose with which the law was introduced. So therefore, our advice, even in the previous law, while there was no clarity, our advice was, on a conservative basis, even example 2 kind of cases should do ESR compliance. And thankfully now that has been clarified that uh, those kind of structures will get covered. And therefore, that is what I was referring to, the fact that we have to keep in mind the intent of the regulations. Similarly, we have to identify the gaps if there are any. For example, coming to the substance test requirement I mentioned, there is a need to demonstrate that you are directed and managed within UAE. Now, for that test to pass, you have to ensure that you have adequately maintained your board resolutions, board meetings have been adequately conducted for the proper events, and those board meetings have been attended physically by the the relevant persons. So those kind of checks have to be done before you even decide or prepare your economic substance report. So you have to do that kind of a test before you decide to file a economic substance return. Implementation, of course, you know uh, uh, implementation may not happen for the first year which has already gone by, but for at least year 2020 and onwards, whichever areas of gaps are there, it will become important, if you can start looking at how we can, what changes needs to be implemented. For example, if there is any change requirement in the intercompany agreement, or if there is any change required with respect to the structuring of the group, like for example holding company or IP holding company, etc. So those kind of structuring or changes can be implemented in advance before the ESR return is filed. Substance demonstration is the ultimate test, and it is important that we identify gaps and implement things in advance so that we are able to demonstrate the substance test adequately. I think that's about it from my side, and I have uh, quick 10 minutes, and if there are any questions that we can take, I would be very happy to take. Yeah, Jiten.
Sure. Thank you, Lokesh, for your presentation. Yes, we do have some questions. So the first one is, with additional exemptions coming in, would a branch of GCC bank operating in UAE be exempt?
Branch of, sorry, I didn't get the question.
Branch with additional exemptions coming in, would a branch of GCC bank operating in UAE be exempt?
So I think coming back to my slides on exemption, yeah. So if you're a branch within UAE of a company which is outside of the UAE, which is the third bucket, then the requirement is to comply with the regulation unless the relevant income of such branch is subject to tax outside of the UAE. So if the branch is paying taxes outside of the UAE, then that branch will be exempt. That was a simple answer to this question. So if you're having a branch which whose income is getting taxed outside of the UAE, then you are exempt under the new regulations as per the plain
Thank you,
reading.
Lokesh. Thank you. Next question is, what is the criteria for an entity to be called not a UAE tax resident if DIFC is not paying any taxes but is carrying on relevant activity? Will it be exempt?
Sorry, Jiten, if you can read or
Sure, sure. What is the criteria for an entity to be called not a UAE tax resident? If a DIFC licensee is not paying any taxes but is carrying on relevant activity.
the criteria, I think, if you are referring to what kind of evidence you need to submit, unfortunately, those evidences have not been clarified under the regulation. But as I mentioned in one of my slides, the indicative evidence could be for this kind of cases is, if you can procure a tax residency certificate saying that you are a tax resident of a country XYZ, which is outside of the UAE, then that could be a very useful document to claim exemption. But like I said, possibly we might see some guidance from the regulatory authorities on this aspect of what are the evidences that you will have to submit. And all I know, Jiten, is that in the previous compliance that we just managed in June 2020, we saw very different set of questions by different regulatory authorities. So for example, the notification form for DIFC was very different compared to JAVSA or notification form for a DAVSA. So even the regulatory authorities, they were having a very different set of requirements or different set of guidelines for their own licensees. So we might see some guidance from the regulatory authorities, but till the time, I would presume that if you have to demonstrate or if you have to prove to the regulatory that you are not a tax resident of UAE, then you have to produce a TRC.
Sure, Lokesh. Thank you. The next question is, what if transactions with related party are not the main activity? And there is a follow-up question also. Doesn't the
Mhm.
definition say that providing services to your related party has to be the main business of the company? And
Yes,
yeah, the person who asked the question is also referring to FAQ number 28.
right, right. So you are right that the essence is that the service center business, the if I were to put it slightly in a broader perspective, what it meant is if you have a unit, if you refer to the original guidances also, it was clarified that even if you have a unit which is providing as simple as administrative support, you qualify to be a service center business. So yes, to the extent when you say that it has to be a primary activity of the UAE entity to provide that kind of or do that kind of activity, yes, it has to be a primary activity. But at the same time, if your analysis of the actual operations of that company suggests that you are doing beyond your primary activity, let's say a couple of more activities which are also falling in the definition, let's say of a lease finance business, etc., then you might have to do compliances for both the relevant activities and not just one. So
Okay, sure.
yeah, there is a possibility, Jiten, that your activities can fall in more than one category of relevant activity. So while your primary business is qualifying to be only one relevant activity.
Okay, great. Thank you, Lokesh.
But one,
The next question,
sorry,
yeah.
Jiten, sorry to cut you, but one important change, if I were to highlight for the related party, is the definition of connected person. That is an important change vis-a-vis the previous law. You have to ensure that you are getting consolidated on a line by line basis. This consolidation on line by line basis itself is subject to many interpretations. So therefore, to answer that question, what needs to be done is first assessed whether the related party is falling in the definition of connected person or not. And second assessment should be to look at the actual operations within that year and whether they are qualifying to be a relevant activity A, or they are qualifying to be a relevant activity A and B both.
Okay, okay, great. Thank you, Lokesh. We still have a couple of minutes, so I'll take two more questions. One is, do you need to submit the evidence for exemption at the time of notification filing?
My gut feeling is yes, it would be required to be. We're looking at the forms of various regulatory authorities in the first stage. I saw a lot of requirements, lot of very different requirements from the different regulators. So you possibly see an option of attachment also within the form only. But this is completely a guess at this stage. The form or prescribed format of the form is yet to be published by the ministry.
Sure. Thank you, Lokesh. The next question is, uh, the, is branch definition for the case of exemption includes those subsidiary companies here in UAE having parent company outside of UAE? I'll
If you
repeat the
are,
question.
yeah,
You
sorry,
clear
go
with the
ahead.
question?
No, I think go ahead.
Okay. Is branch definition for the case of exemption includes those subsidiary companies here in UAE having parent company outside of UAE?
Slightly, I see a confusion in the question, because if you are a subsidiary, then you can't qualify as a branch. So possibly we need to, maybe we can discuss this, on the email. And if you can write an email to us, we'll try and respond to it. But
Sure, Lokesh.
I find that this question is not very clear.
Sure,
Yes.
Lokesh. The last question is, the branch is subject to tax in another country, but due to certain exemptions in that country, they are not subject to tax. Will the exemption still apply?
The branch is subject to tax outside of the
In
UAE,
another country, yeah.
right?
But due to certain exemptions in that country, they are not
Mhm.
subject to tax. Will the exemption apply?
Hmm. That's a tricky question. That if you are subject to tax but exempt for given the local regulations, while I would say that we should still analyze the reason for claiming that exemption or read a little bit more on the local regulation before we comment on it. But prima facie, as long as you were a tax resident of that jurisdiction, you should be able to claim an exemption. But this is only prima facie. I would believe that we should look at facts a little bit in more detail before we comment on it.
Sure, Lucas. Thank you so much. Thank you so much. So, thank you, everyone, for joining us today. We hope the insights shared by Lokesh have been useful to all of you. And if you have any further questions, please write to us and at thinknext@nextline.com, and we'll be happy to respond to you. Thank you once again for joining in. Stay safe, stay vigilant.
Thank you. Thank you all.